All right, buckle up for another deep dive. Today, we're exploring a truly intriguing corner of the investment world, mobile home parks. You might think, mobile home parks? Really, what's there to dissect? But trust us, for those of you already tracking this niche, the insights we've pulled from our expert sources are surprisingly compelling.
Yeah, they really are.
Our goal today is to, well, cut through the noise and give you the essential playbook for understanding what really drives success in this space. We'll guide you step by step through the core financial principles.
Exactly. We're going to unpack what our sources refer to as the 4 C's of mobile home park investing.
Okay.
These aren't just arbitrary terms. They are quite simply the 4 crucial units of measure that determine the viability and the profitability of any deal in this sector.
Right.
If you master these, you gain a significant advantage in understanding not just individual properties, but, the market dynamics as a whole.
So 4 C's, huh? That sounds like a clear, almost coded framework. But why these 4 specific metrics? I mean, are there other common measures investors often look at that our sources say are maybe less critical or even misleading when it comes specifically to mobile home parks?
That's a great question, and it gets right to the heart of why these 4 are so foundational. The research we've analyzed emphasizes that these 4 C's boil down to the absolute essentials for evaluating mobile home park, or MHP, deals.
Okay.
While, sure, general real estate metrics are useful, these 4 particularly tailored to the MHP structure. They are the building blocks.
Building blocks, yeah.
And understanding each one, and crucially how they interrelate, that's the key to mastering your performance and ensuring you meet your budget and, well, your expectations for profitability. So we're going to break down each one, clarify its definition, and explain its unique significance for your investment journey.
All right, let's jump into the first C then. The cap rate. Now, I've heard this term used widely in general real estate, but for mobile home parks, what's its specific significance? Why is it considered the absolute starting point for valuation?
The cap rate or capitalization rate is indeed fundamental. It's presented as a simple fraction, the property's net income divided by its total cost.
Okay, net income over cost.
Right. Think of it as a snapshot, a quick way to gauge the potential unleveraged return on an investment property.
Unleveraged, okay.
For you as a potential buyer, a higher cap rate is generally more attractive. It indicates a higher immediate return relative to the cost of the property.
Makes sense.
Conversely, a lower one tends to favor the seller in the transaction. It's really that initial signal of a deal's perceived value.
So if a higher cap rate is generally better, what does a good cap rate actually look like in the MHP world? Is there like a specific target that our sources point to as ideal?
Yeah, the material we reviewed highlights a very specific target. What makes a cap rate good in this niche is achieving a 3-point spread between the cap rate and your loan's interest rate.
A 3-point spread between the cap rate and the interest rate.
Exactly. This 3-point difference is critical because, according to these experts, it's often the key to reaching that highly sought-after 20% cash-on-cash yield. That's a number astute investors frequently target in this space.
Wow. Okay, so like if your loan is at 6%?
Then the research suggests aiming for a cap rate of around 9% on the property itself. That 3% difference, that's often the sweet spot.
That's a very precise target. A 3-point spread aiming for a 20% cash-on-cash yield.
Yeah.
But I imagine, like with anything financial, getting the right numbers to begin with is absolutely critical. Otherwise, the whole calculation just falls apart, right?
Oh, absolutely. And here's where it gets really interesting and, frankly, often overlooked by less experienced investors.
Yeah.
You must know the true granular numbers.
True numbers.
What is the real net income, not just what's maybe puffed up on a pro forma, and what is the real total cost? Making absolutely sure to include any capital improvements needed immediately after you buy it.
Right, the hidden costs.
Exactly. Our sources often joke that the difference between an amateur and a seasoned investor in this space is whether they've ever found a surprise capital improvement after closing a deal.
Ouch. Yeah, I can see that.
It's why meticulously vetting those true numbers, not just the asking price, is non-negotiable. If you start with fuzzy numbers, I mean, everything else downstream is going to be off, and that crucial 3-point spread could just vanish overnight.
That makes a lot of sense. Getting those true costs up front is foundational for the cap rate calculation. But okay, once you've sized up the potential return with the cap rate, the next crucial step, especially when financing is involved, involves keeping the bank happy. That brings us to our second C, the coverage ratio. This sounds like something the lenders really care about, yeah.
You're absolutely right. When you get a bank loan, And let's be honest, nearly all MHP investors utilize debt. The bank's primary concern is feeling secure. They want to know their investment is safe.
Sure.
They use the coverage ratio to measure this safety. It assesses whether the property can comfortably cover its financial obligations. It's basically their litmus test for risk.
So how do they measure that safety? What's the specific number they're looking for, and what does it really signify for us as investors?
Well, it's how much a property's net income can cover its mortgage payment, usually with a little left over for unexpected issues, what our sources sometimes call a rainy day fund.
A buffer.
Exactly, a buffer. Most lenders want to see a 1.2x coverage ratio.
1.2x. Okay, what does that mean practically?
It means the property's net income needs to cover 120% of the mortgage payment, not just 100%. So if your monthly mortgage payment is, say, $10,000, the property needs to generate at least $12,000 in net income.
Okay, so that extra $2,000 is the buffer.
That extra 20%, yeah, that's the buffer the bank requires to feel secure. It protects them if maybe rents dip slightly or expenses unexpectedly pop up.
Right.
And this is a crucial number because, well, it also helps keep you out of trouble. And it's a number that every single lender is going to scrutinize. Understanding this gives you direct insight into how the lender thinks and helps you evaluate risk, making sure you're not over-leveraging your investment. It also signals a stable asset generally.
A 1.2x coverage ratio definitely makes sense for the bank's security. But think about it from the investor's side. Is there a point where too much buffer, maybe like 1.5x or 2x, might mean you're actually leaving potential returns on the table, according to our sources? Or is more always better here?
That's a sophisticated question. And yes, while a higher coverage ratio certainly makes a lender even happier, the experts we reviewed suggest that an excessively high ratio could, in some cases, imply a few things. Maybe a very conservative financing structure. Or even that the property is under-leveraged relative to its potential. It might mean you're using more of your own capital than necessary.
Oh.
Or perhaps you miss an opportunity for a higher loan amount, maybe to acquire additional assets or do more improvements. So the sweet spot is really meeting that lender's requirement comfortably, like the 1.2x, without necessarily sacrificing efficiency in how you deploy your capital. It's definitely a balance.
Okay, that's a great nuance. So we had the cap rate for initial return, coverage ratio for lender safety. But after all the numbers for the bank are sorted, the real question for you, the investor, is what am I actually getting back for my direct investment? And that's where the third C comes in, cash-on-cash return. This one sounds like it's directly about the investor's personal payout.
It absolutely is. This C is entirely about what you get back on your down payment, the actual cash you personally put into the deal.
Your skin in the game.
Exactly. It's a direct, unfiltered measure of your personal investment's performance, quite distinct from the overall property return or the cap rate we discussed.
So how do we calculate that one? What exactly goes into the cash-on-cash return? Is it just the pure income we see each month hitting the account?
Not quite just the monthly income. The cash-on-cash return is defined as the total money you receive. And this includes something our sources refer to as a phantom gain from your principal paydown, divided by the money you initially put down.
Phantom gain. Okay.
Yeah, it's an interesting term, right? But what's fascinating here is the potential return it points to. Our sources provocatively ask, can you name another investment that consistently yields 20% or more like a well-run mobile home park? Now, that highlights the potential for really substantial returns on your own capital in this specific investment type, especially when structured correctly. But that phantom gain is part of the calculation.
Okay, phantom gain. That sounds intriguing, almost mysterious. Can you break down what our sources mean by that, and why is it so important for understanding the overall return, not just the cash in hand?
Right. It's a vital concept because it broadens how we define return beyond just, immediate cash. That phantom gain from principal paydown refers to the portion of your mortgage payment that goes towards reducing the loan's principal balance.
Ah, the part that's building equity.
Precisely. Our sources explain that this acts like an enforced savings account. So, for example, if you pay down, say, $1,000 in principal this year, that's $1,000 in equity you've effectively gained.
Right.
You're getting it back in the long run, even if it's not immediate cash in your hand today. It's a form of wealth creation and equity buildup that significantly adds to your total return over time.
Okay, that makes sense.
And it raises an important question about how we define return. It's not just about the immediate cash flow hitting your account, but also about building that long-term equity and ultimately your net worth.
Now, back to that 20% figure. Our sources mention that well-run mobile home parks can consistently yield 20% or more cash on cash. That's a bold statement, especially in today's market. Does the research offer any caveats?
Yeah.
Or specific market conditions where hitting that 20% might be harder? Or is it really presented as a consistent benchmark?
That's a critical point to explore, definitely. While 20% is presented as an achievable target, the research is quite clear. It's not a guaranteed outcome.
Right, requires work.
Exactly. The well-run part of that statement is absolutely key. It requires diligent management, accurate initial due diligence, going back to getting those real numbers we talked about, and often an ability to effectively implement value-add strategies after you buy.
Okay.
Market conditions, definitely interest rates, and the specific property's starting performance all play a huge role. It's a target for astute investors who really understand the operational side of things, not just a passive investment where you sit back and collect 20%.
An enforced savings account through principal paydown.
Yeah.
That's a great way to think about that phantom gain. So, okay, if cash on cash is about the total return on your initial investment and building that long-term equity, what's the final C, cash flow, all about? How does it differ, and why is it crucial not to confuse the two?
Right. The final C, cash flow, is very different from cash-on-cash return. And it's really essential not to confuse them because they serve distinct yet equally important purposes for you as an investor. Cash flow is much more immediate and, well, operational.
Okay, so define cash flow for us, Dan. How does it really differ from cash on cash in practical terms for someone actually holding the investment day to day?
So cash flow is simply the amount of money you have left over in your pocket at the end of each month after you've paid the mortgage and all other operating costs.
All the bills.
Everything. Utilities, maintenance, property taxes, insurance, any management fees,
Yep.
all of it. It's your actual monthly operating profit, the money that lands in your bank account, ready for you to use or reinvest.
Got it. Money in the bank, month to month.
Exactly. The distinction is key. While cash on cash looks at the overall return on your initial investment over a longer period, including that equity buildup, that phantom gain, cash flow tells you what income you're currently generating right now, month to month.
Okay.
A healthy deal, the experts stress, really needs both. You want an attractive cash on cash return for that long-term wealth building, and you need healthy, consistent cash flow. That provides the essential short-term income and liquidity. You really need both legs for a truly successful investment.
That makes perfect sense. Getting both the long-term growth and the immediate income is definitely the ideal scenario. Now, this is a question many active investors will have. Can an investor actually improve this monthly cash flow significantly after they've bought the property? Or is it mostly kind of locked in by the purchase price and the initial financing?
That's where active intelligent management really shines in MHP investing. And the answer is yes, absolutely. What's particularly useful to know, and what our sources emphasize, is that you can enhance that cash flow significantly after you acquire the property.
Okay, how? What kind of strategies do they mention?
Well, they don't just list strategies. They kind of dive into how you do it effectively. For instance, raising rents isn't just about arbitrary hikes. It's often tied to making small, tangible, value-add improvements to justify those increases.
Like what?
Things like maybe paving a dirt road, upgrading old utility hookups, or improving common areas like a playground or laundry facility, things residents see and value.
Right, improving the living experience.
Exactly. Then there's filling vacant lots. That often involves strategic marketing, maybe targeting a specific demographic, perhaps partnering with local mobile home dealers. It's about understanding local housing demand and offering the right incentives to get those lots filled and generating revenue.
Makes sense.
And of course, diligently cutting unnecessary costs. That could involve anything from optimizing utility usage, maybe submetering water, to negotiating better service contracts for things like trash removal, or even just implementing more efficient maintenance schedules. It's really about active, intelligent management and having a clear understanding of your property's potential levers.
Well, we've certainly pulled back the curtain on the cap rate, coverage ratio, cash-on-cash return, and cash flow.
Yeah.
Wow, what a deep dive into the practical math of mobile home park investing. It's really clear these aren't just isolated metrics, are they? They're truly interconnected pieces of a much larger and very practical financial puzzle in this specific niche.
Absolutely. The research makes it abundantly clear. Mastering these 4 C's is presented as the key to mastering your performance and ensuring you actually meet your budget and expectations in MHB investing. It's about looking beyond just the surface numbers,
Yeah.
Understanding the true financial health and the real potential of a deal from multiple angles. It gives you a holistic, actionable view of the investment, not just one number.
So, for you listening, whether you're actively evaluating investment opportunities in this space, or maybe just curious about how these assets are analyzed by the pros, understanding these 4 C's, cap rate, coverage ratio, cash on cash, and cash flow, gives you a powerful foundational framework. It helps you assess the viability and potential return of any mobile home park investment that comes across your desk.
And this raises an important question, maybe something for you to ponder after this. How might understanding these detailed financial metrics in one specific niche, like mobile home parks, change the way you evaluate any other potential investment?
Good question.
Whether it's stocks or maybe other types of real estate or even thinking about starting a small business. Think about which of these C's might apply, perhaps in different forms elsewhere, and what other critical C's or unique metrics might exist in those different fields that are just as essential to their success. This framework of deep financial analysis, it can be applied far beyond just mobile home parks. It really prompts you to dig deeper, doesn't it? To find the true drivers of value, whatever the investment may be.